2012 is shaping up to be the year of global political change, with interesting turnovers in governments in countries such as Italy, France, Russia, and of course with the upcoming presidential election here in the United States. How will these events shape up global capital markets, and how can investors prepare for it? My name is Davide Accomazzo, adjunct professor of finance at the Grazie Dio School of Business and Management at Pepperdine University and portfolio manager with Thalassa Capital. Welcome to A Wall of Worry, Elections and Markets, a faculty panel discussion for the Grazie Dio Business Review. I'm joined today by fellow faculty members Edward Fredericks, practitioner faculty of finance and principal of Eastwind Asset Management. Edward has expertise in intelligent database technologies, advanced financial asset valuation, and behavioral issues in financial decision making. He also holds the CFA charts. Welcome.
Thank you. Glad to be here.
And Clemens Kownatzki, adjunct professor of financial risk management and founder and CEO of FX Investment Strategies, a registered investment advisor. Welcome, Clemens.
Thanks, David. Glad to be here.
And last but certainly not least, Michael Shires, PhD, associate professor of public policy here at Pepperdine University. Michael's primary areas of teaching and research include state, regional, and local policy, technology and democracy, higher education policy, strategic, political, and organizational issues, and of course, quantitative analysis. He is also an active consultant to local and state governments. Hi, Michael.
It's great to be here today.
Okay, so let's get started. Americans could not be facing a more polarized elections this year. Romney and Obama seem to be at the opposite end of the spectrum on almost every issue, from fiscal policy to economic stimulus to regulations. What can investors do to prepare for such a polarized potential event?
If there was something they can do, it's probably too late to do it, given that it's here and the election is just a few months away. The key is what would be the difference given a Romney White House versus an Obama White House. And it's no secret Obama's anti-business attitude or rhetoric. Many people have commented on it. Many people are frightened by it. And I think Romney is utilizing that anti-business attitude in his campaign. So many people have the expectation that Romney will win the White House, and if he does, the expectation is for a much more business-friendly stance from Washington, or a set of policies coming out of Washington. And perhaps this is a big question mark. Exactly how effective will be his policies in terms of providing stimulus and giving the economy a little bit of a boost in the arm. You have to admit that given the amount of debt we have, given the condition that we are in, perhaps Romney has not a lot of choice in terms of his policies that he can implement. But many people are much more inclined to look forward to a Romney White House versus a second term for Obama. In terms of Obama, I think the big question is, given the criticism that he has, and given what will probably be a close election if he does win it, will he moderate his rhetoric? Will he moderate his stance on some of the regulatory issues? Will he be a much more friendlier person to business, such as Bill Clinton was in his second term as president? So I think that's the big question. If Obama continues on and says that if he wins this election, that's a vindication for his policies, then I think that, again, it's too late really to do much to your portfolio to prepare for that. But possibly you'll see better performance in commodities such as gold and those types of assets.
But let me be a little bit provocative here. And after all, since from an investor perspective, since the beginning of the Obama administration, the market is up about 75%. Is maybe all this anti-business rhetoric just that, or there's something more to the noise?
Well, if you compare Obama's first term with Bush's first term, or even his second term, based on just S&P 500 performance, Obama has been much more successful, just by the sheer numbers.
Right.
So if I look at Obama's tenure so far, probably somewhere between 60 and 70% up, whereas Bush was 8% down in his first term, and I think it was set 26 or 25% down in his second term, from the beginning of his term until the end of his term. So from that perspective, Obama has the upper hand. However, if we look at nominal performance, that's one thing. Real performance is yet another. And here I have massive issues. For one thing, the real incentives to actually produce something are gone. We have zero interest rates, negative real interest rates. There's only so much stimulus you can do, but one effect that the Fed was trying to do is to inflate asset prices has worked with stocks, because there's really nowhere else to go. Where else can you put your money other than gold, perhaps?
Right.
And foreign investments, yes, perhaps, but we have the same issues. We have European interest rates that are next to zero. Japanese interest rates are basically zero. China has had problems with their growth rate. So I'm not sure if this is really the effect of prudent or smart policy, but rather the effect of smart money putting wherever the money is best invested. So I'm not sure if really the Obama can take credit for all of this, but rather than the market has nowhere else to go other than investing in equities, because everywhere else your money is going to be diluted.
Mike, what's your point?
Yeah, and I think that's an important comparison. I mean, I think if you look at the Bush administration, he came in at the dot-com peak, and then you have September 11th stacked on top of that, and the economy still managed to come out of that. And it came out of it at a time when there were other investment opportunities that were attractive. You could buy housing, there were a lot of things you could invest in that were attractive, and the market still did well. If you look at today, nothing else is doing anything. And the equities are the only place that people can turn. So, I mean, if I was an investor looking forward to this, I mean, I think that Obama is very focused on government's role in reorganizing the economy, trying to bring it back to life. And I think Romney will take an approach that says, we can't do that, we need to get government out of the way. And, you know, Obama hasn't hurt investors a lot at this point because the regulation has been very focused on environmental issues, sort of, you know, production issues. Those things are going to start having consequences. We're going to see that production moving offshore more and more. We've already seen it in California where we did these things, moving to other parts of the nation and overseas. And as those regulatory effects start to shape our economy, we're going to see employment go with it. And I think one of the big challenges that we really have to look at is which of these two candidates is more likely to stimulate employment over the next decade in the private sector.
Be pro-capitalist, so to speak.
Yeah, and I mean, clearly Romney has better credentials there. I don't expect Obama to be more focused on legacy as he really believes, I think, the government has the leverage to change these things. So if I'm on the investment side, I'm kind of looking at this as Obama's mostly leading, and even if he doesn't, you want to buy the things that are going to do well under his administration. You know, the green energy, obviously,
Right.
and that kind of stuff. And then if Romney wins, you quickly diversify to other things where you know that deregulation is going to start producing returns in those sectors. But I think up front, you kind of want to plan for what, I think in the long term, an investor scenario is going to be the worst case scenario, which is an Obama win with continued and probably expanding regulation in that second term.
Well, on the topic of regulations, you may have something to say.
Well, I do, David, but before we go there, sticking with the Obama, the comment was made that he hasn't hurt people yet, and that certainly isn't for lack of trying, right? I mean, he's been trying to raise taxes on what he calls the rich, but he's also been targeting things like dividends, right, which many people have holdings in common stock, and the tax rates there are 15%, and he's been trying to raise them to a common income. Also, too, I think to say that the S&P has been a good investment because of Washington, I think is overlooking quite a lot. And the reason the S&P has done well is in when Obama took office January 1st, where was the S&P? The S&P was reeling because of the crash in commodities as well as the crash in housing. In March of the first year that Obama was president, the S&P touched 700.
666.
666. Now, see, there's a warning.
Point nine.
And so, given that things were in that bad, perhaps you could sit there blind and sit on your hands and not do anything. And eventually, as you say, maybe the Austrian school of thought, right, leave the markets to their own devices. Eventually, we'd have recovery given how well some U.S. companies are performing. And so perhaps you could have easily duplicated his track record in terms of investment returns. Think of what could have happened, though, if the right policies or the right messages were sent. DoddFrank, if that was postponed. Perhaps the time he spent with healthcare, if that was more earmarked or directed towards improving the economy, improving employment, versus just trying to fight the political fights that were needed to get healthcare passed. So I think in a way he has hurt people by not focusing on the right issues. And I think Dodd-Frank in and of itself has many aspects of it which currently has hurt people. And one point I talked to with, or referred to as to Dodd-Frank is banks not being able to do proprietary trading. And last year we saw quite a bit of volatility in the markets during the summer. And many people with knowledge and insight into the markets and their functioning said that really what caused that volatility was not concern and people adjusting positions over some type of economic event or European event, but it was people that were able to push the market around with their trading to reap profits because banks were not there. A very big presence that had traditionally been there was no longer there because of Dodd-Frank, right? Banks couldn't do their own proprietary trading. And because of that, apparently there was a lot of people who did see that asset prices were very, very prone to manipulation. And given how quickly that volatility occurred and then disappeared or dissipated, I think you can only put your finger on some type of manipulation.
Well, small add-on to that. Actually, the banks haven't left the market in terms of proprietary trading. They just shifted overseas.
Well, they
Hence,
shifted some
JP Morgan,
overseas.
You know, the JP Morgan issue just a few months back. I think the problem is the lack of liquidity that makes markets oscillate much faster and increased volatility as a result of that.
How can you say liquidity when interest rates are at 0%?
Liquidity in terms of market making.
So in a sense, the presence is not as aggressive as it used to be,
No, if you have a thinner market, prices jump quite easily.
Oh, I agree. That's my point.
Also.
That's what I've heard was happening.
Yes.
That there was not the people that were there to take up the volume, to take the other side of the trade. Hence, you could easily put in, say, a phantom trade, move the spread down, and quickly
Well, I
profit
will
from
also
that.
argue that it's not just a question of liquidity, but you have to look at the quality of liquidity. And when the majority of the volume, the daily liquidity is provided by high-frequency trading,
Right.
that obviously,
Which aren't market makers.
which
per
are
se.
not really market makers, that obviously will increase the volatility of the market. But on the banks, I like what you said, and I want to continue down that path because I do have issues with Dodd-Frank as well, even though for a different reason than you do. But it seems to me like Dodd-Frank was trying to address a situation of the too big to fail and correct the systemic imbalance that was created by this big supermarket banks that we had at the beginning of the crisis. And yet, after 3,000 pages of regulations, we still have 10 banks that manage, 3/4 of the liquidity in this country. And they're still systemically dangerous. And they're
And-
still probably $50 billion short in capital requirements.
And we're starting to see the shadow banking system come back,
Right.
unregulated
Exactly.
financial services companies.
And we still have situations like MF Global, I like to add. So what's your take? I mean, what does it take to really reshape the situation here? Obviously, Dodd-Frank doesn't seem to be the answer.
I have massive issues with Dodd-Frank. When I first heard about it, I just shook my head in disbelief. And I heard at the time one really remarkable comment, because there was this talk of this new super regulator that was going to come. And I think it was
For
an
the
economist.
consumer?
For the consumer, but also for the entire financial services industry. And that comment I heard was so significant. It was something like, a super regulator requires superhumans or superhuman beings, and they just aren't available. You know, we don't have the type of people that have the experience, the skill, and the integrity to regulate the
Well,
market.
these people are not aware of the Pepperdine MBA.
Perhaps not. Perhaps not. But they aren't around. Because for the most part, regulators are accountants and lawyers. And we know what that path is leading towards. Not to bag on lawyers, but we have an issue from just a pure competence and from a pure, I want to say, gut feel approach to regulation.
Right.
You know, if anyone has spent a few hours or a few weeks on a trading floor, you can tell fairly quickly what's wrong and what needs to be done.
Yeah.
But if you just sit in your office and read over financial statements or look at capital ratios or value at risk, you're never going to see what's really going on in the market, and that needs to change.
And if, in the case of Bernie Madoff, was it? You know, if you're also dating his daughter, I guess you're also prone to possibly look the other
But
way.
that brings up another good point, the fact that we do have a lot of regulations. The problem is enforcing regulations. So,
Well, what happened to MF Global? We have the CFTC, we have the CME,
Mhm.
supposed to actually regulate all of this. $1.6 billion are still outstanding from a year ago.
Yeah.
Nobody can find it. How is that possible?
And the CEO is out walking around trying to start a hedge fund.
Hedge fund, exactly,
Yeah.
which
Well-
is quite laughable.
I mean, I think it makes the case Dodd-Frank solved the wrong problem. I mean, the problem was not, is our banking system broken? Our banks know how to loan money, they know what they're doing.
Right.
It's the investment side of the banks and their dependency on those investments to generate earnings that has created sort of this imbalance in the system. And Dodd-Frank did nothing, especially with the big banks in that area. It really regulated the regional banks, which were sort of the vehicle for our economic recovery, right? I mean, they're the ones
But
that...
why that? Is it because both parties, I should say, have a vested interest in keeping the system the way it is?
Well, I think when they wrote Dodd-Frank, they sat down with the banks and said, how do we fix this? How do we create balance in the banking system? And I think their voice might have been a little overrepresented at the table. Some of these other institutions, especially the regional banks and the mid-tier banks, weren't there, and their voices weren't heard as much. And they're actually the ones that carry the water when it's time to reinvest in the economy.
Well,
What's your take?
I haven't heard exactly how it's affecting regional banks, but savings and loans and smaller banks, one of the problems that was seen that caused the problem was the originate and distribute business model, right? That these banks would originate the mortgage, and instead of keeping it on their balance sheet, they would send it to Fannie or Freddie Mac. And I have not heard anything that has shut that down. There has been some talk about requiring banks to maintain a small equity position in the loan, or that loan, when it's sold, it is to have the information of who underwrote it, so that there might be some recourse. But I haven't seen the laws, I haven't seen the regulations. So again, getting as to Dodd-Frank, I think there was a lot of finger pointing going around. And I think finger pointing was directed at the easiest, the biggest targets, which again is Wall Street, right? The fat cats. And Dodd-Frank is a lot of regulations for problems that either didn't exist or we're trying to solve one problem by, again, addressing other problems or other situations. So I think it's something that really needs to be put on the table and examined. What I hear also, too, is that a great majority of Dodd-Frank still yet needs to be implemented.
Yes.
And the reason why it's not implemented is because it's still not clearly defined what the regulation is, and they have to sit down and determine this. So, it just sounds like a real mess. It sounds like a lot of fluff.
In addition, there's a systemic issue I have with regulation. When you know that Jimmy Dimon sits on the board of the New York Fed, there's something systemically wrong with regulation that cannot be right. How can the guy who's supposed to be regulated be the police officer? That doesn't work.
Well, that's the problem too. As you pointed out, you need some knowledge of the industry to regulate it. And so where do they recruit from? They recruit from the industry, right? A lot of regulators, I guess, are ex-traders or whatever. And so they have contacts, they have ties, there's interwoven boards, what have you. So,
And yet another thing in terms of regulation, I've always felt that a very easy tool to regulate the markets is just pull out the leverage out of the system. For instance, if you have a mortgage and you allow people to have a zero down mortgage or even a 5% mortgage.
Oh, well, underwriting
to me,
standards,
it's just
definitely.
ridiculous.
Yeah.
I mean, how in the world would you feel that you can buy a house that's worth $500,000 and you make $30,000 or even less a year? How does that work? It just doesn't click with me.
One of the big policy problems is that who is responsible for that? Someone out there had to be responsible for no-doc loans, liar loans. I mean, they were actually called liar loans. I'm trying to get a line of credit right now, just a HELOC, right? A home equity line of credit. Redo our bathroom, what have you. And the documentation they wanted is like unusual, just very unusual, the depth of it. And thinking back to these liar loans or these no-doc loans, who in their right mind thought we weren't going to get in trouble with those, right? I mean, in hindsight, maybe I can say that confidently, but really, it's ridiculous. So there's some type of policy out there that this really slipped through the cracks.
Well, I think
and
perhaps
that was allowed to happen.
an answer to that was the combustion of two elements coming together. One was the breakdown in the regulatory process during the bubble, and the great global liquidity, or the global savings glut, as Bernanke called it.
Yeah, I don't know about the liquidity though. It's like if
Isn't
I have money you will borrow. I mean.
Well, no, but that forced the banks to be more aggressive.
Pushing down a loan down your
Right.
throat. I guess in a way I could see that, but still, I still question how it could be legal at any point to have even a 5% down payment on a mortgage. That to me just doesn't seem right.
Yeah.
But it gets better today, right? I mean, the latest initiative by the administration is the HARP 2, right? Go refinance your loan only if you're upside down.
Mm-hmm.
You don't
Right.
qualify for the
Right.
program unless you're upside
Right.
down in
Yeah.
the loan.
Oh, that's
And-
unbelievable.
I mean, it's almost like we didn't learn anything from the last time around.
Yeah.
Let's create loans that we know aren't going to work. Okay, let's create a whole bunch of new ones.
Yeah, yeah, and those people that didn't pay now, let's give them more money. You know, I mean,
that seemed to be the plan here. So let's move to another big topic here, the fiscal cliff.
can I, before we go
Sure.
there, I need to mention too that I bank with a credit union, and this really surprised me. And it surprised me to the point that if anyone else out there has a very, very close relationship with an institution, call them and ask them about a renegotiation of their loan. I was looking to refinance, right? My original mortgage is at 4.25%, and I was looking to get one of these, 2.875s that my credit union advertises. The closing fees were just enormous, right? Just enormous. I think about $14,000 worth of closing fees. And that's because, it's again like a whole new transaction again, right? So it has to be recorded with LA and pay the taxes to LA, what have you. So they said, well, would you be interested in a modification? And they looked at my credit record, they looked at my loan, and they came back and they said they would modify me from 4.25% down to 3.375. There would be no starting of the loan, so I'm already, amortizing already. And it cost me $22. And that's $11 for a credit check for me, $11 for a credit check for someone, for my significant other pay. And they even did the appraisal online, went to an electronic service and charged me nothing for that. So I don't know if this is a Navy Federal Credit Union program or if this is a federal program. I don't know where this originated from, but I have a good credit score. My significant other does too. They came to me and said, have you thought about it? I just don't know where it came from. I'm glad it's there.